these are important things to understand. And I'm telling you, this is so vital if you're thinking about long-term tax liability, because long-term tax liability is one of the most important things to understand when it comes to your wealth creation. You can either give the government more money than necessary and reduce that from your lifestyle, reduce that from your legacy and your family heritage, or you can control that money and you can make decisions that aren't short-sighted. The biggest problem with money is people don't have a long-term view. They're just thinking, how do I get my deduction this year? When they don't realize they're not getting a deduction, they're getting a deferral, and it goes into the future, right? And so when you look at this, check this out. Hey, what's going on, cash flow hackers? It's Chris with Life 180, and for this video, I want to talk to you about the 3 biggest lies that Wall Street is telling you about your money and why it's so important to understand these lies. And when you understand these lies, I think will have a drastic impact on the financial strategies you use, how you handle your money, how you plan for your future, how you plan for your own wealth creation strategies, and we will go from there. So let's get right into this. The first one is the concept of a tax deduction versus a tax deferral. Now, a lot of people believe that when you put money into a qualified account, you are getting a tax deduction because of the fact that you get to deduct that amount of money on your taxes. If you make $100,000 a year and you contribute $10,000 to a 401k, you get to deduct the $10,000 off your earned income and you pay taxes on the $90,000. So most people think that's a deduction. What they don't realize is that the $10,000 you're putting in there, you're not really getting a deduction, because the deduction says, I get just a benefit. It's straight benefit for doing that. What you're getting is you're getting a deferral. And when you put money into a 401k, you're actually kicking the can down the road to pay taxes. Now, what I want to do here is I want to show you a screen share, and I want to show you the history of taxes and let you see why I think a deferral made sense once upon a time, i.e. when the environment changes around us and the economic and political and all these different landscapes change around us, that has to change the way that we think about our money and the decisions that we make about our money. And if we understand these principles about how money works, then you can make an educated decision on what's right for you. That's the way I look at this stuff. So before I get into it, what I want to do is I want to share my screen here and show you a copy of the history of taxes over the last 100 years. All right, so let's take a look at this really quickly. So if you look at where we are right now, look at 2021 in taxes, there was 37% taxes over $628,000. Now, mind you, we got to keep inflation into consideration. So when we look at this, the tax thresholds and the actual tax amounts, taxes are relatively low, right? So we gotta understand history if we can make decisions based on what our future looks like, because history has a habit of repeating itself, right? So you can see taxes at all low rates here in the 20s. They got really jacked up because of the wars here for a period of time. You can see during World War II, the Korean War, all these different things going on. They got high all the way through Vietnam in the 70s. Taxes were really high, right? So now you can see they're really low. In 1980, what I want to do here is say, this is really important to understand. Taxes were 50% on household income in 1982. Let's go back to 1981 when taxes first start. These are important things to understand. And I'm telling you, this is so vital if you're thinking about long-term tax liability, because long-term tax liability is one of the most important things to understand when it comes to your wealth creation. You can either give the government more money than necessary and reduce that from your lifestyle, reduce that from your legacy and your family heritage, or you can control that money and you can make decisions that aren't short-sighted. The biggest problem with money is people don't have a long-term view. They're just thinking, how do I get my deduction this year? When they don't realize they're not getting a deduction, they're getting a deferral, and it goes into the future, right? And so when you look at this, check this out. 1981, people were paying 69%, almost 70% on household incomes over $215,000, okay? So when you break that down, look at what happens. This is crazy. So the threshold drops. So most people would look at this and go, well, it went from 69 to 50%. If you just look at the numbers here, right? 69 to 50. But look what happened to the threshold. The 50% dropped to $85,000 in 1982. So yeah, they reduced the taxes, but a higher percentage of the people were responsible for paying that amount of tax. Now, you can see the same thing goes here. Taxes actually dropped to 28%, but it's a much more level kind of playing field, right? 28% over $29,000 of income, right? That was the top bracket. That's kind of crazy to think about this day and age. And then from that point forward, you could see taxes kind of went up. We've leveled off. Taxes, when you take inflation into account, yeah, 37% is a big number when compared to recent history, if we want to talk over the past 15 years, 20 years or so. However, you can see that since let's say 1993, we've been between 39 and 35% taxes. Like the top marginal rate doesn't change, but what changes is the threshold, right? So 628 is the number now. You can see 450, 464 in 2015. So that number is way outpaced inflation, right? And you can see way back here, 1993, it was 250,000, right? So the tax rate hasn't gone up that much, but the threshold has changed, and that's where they get people, right? Now, the other thing to think about here is that when 401ks and IRAs were first created, it was 1980, 1981, 1982. That's when the market really started to flood into these things. It made sense. This is when people's paradigms were built on whether 401ks, IRAs, qualified plans were good or not. At this point in time, listen, if I had the ability to defer taxes in a 69% environment, or defer taxes in even a 50% environment with this, and I could take out at a 35% environment, I'm all over that. You're winning, right? But here's the problem. Right now, we're at these low long-term rates, and we're at all-time highs in debt. We're at all-time lows in interest rates. Things have nowhere to go but worse at this point in time from a perspective of how our taxes going to be impacted, right? Because don't forget, and the reason I mentioned interest rates being low is because when interest rates are low, what happens is the cost to service our debt as a country remains lower. As interest rates go up, which by the way, they have to go up right now to be able to counter inflation. Otherwise, we're going to have all sorts of problems. If interest rates go up, what's going to happen is it's going to cost more money to service our debt on an annual basis. Therefore, the government is going to be short on revenue. So on top of fighting inflation to raise interest rates, to do that, they're going to have to counter that with more taxes to cover the annual deficit, because it's just an expense, right? It's going to be a huge expense on the P&L of the country, so to speak, right? It's going to be. There's no way around that, right? So like you have to look at all these facets that go into this. So how you're being lied to about tax deductions versus tax deferrals, versus the fact that it is actually a tax deferral, is one of the most important things to understand. And if you don't understand that, you can see here. So what I want to do here really quickly is just show you a history of the tax thresholds, right? Because this is really important to understand, because I got done showing you the last page got done showing you the fact that what the top threshold was, but this gets into what are the bottom thresholds. So I'm not going to spend a lot of time on pre-1980, but right here you can see talking 14% on income over $3,400 in 1981, 1980, even 1979 and 1978 was in that same range, right? Now you can see the top thresholds were here. This doesn't give all the thresholds in between, but you're talking 70% over 215. They dropped the threshold. You can see the 50% tax rate. The thresholds kept going up, so that was a little bit of tax relief. But right now, look at the bottom threshold. Check this out. Check this out. Look at this. In 2000, the bottom threshold went down, and this is where I'm saying, like, everybody's thinking that the middle class is overtaxed, that the poor people are overtaxed. The poor people right now are taxed less than ever, and they need to understand that. The problem with it isn't how much they're paying. The problem is their lack of understanding, and lack of understanding about how money works and what to do about it, right? And so what I really wanted to do in this video is kind of be able to break that down for you and show you the concept of tax deferrals versus tax deductions. And ultimately, I started this video on talking about the 3 biggest lies about your money. But what I'm gonna do now, because I talked about this way longer than I thought I would, because I don't script this stuff out, and I kind of warn everybody about that all the time, but I'm gonna actually do a 3-part series now and make it, because otherwise this video is gonna get way too long, but I'm gonna do a 3-part series on this. So be looking out on the next video tomorrow about the second lie that Wall Street is telling you about your money. I hope you found value in this. If you did, please hit that subscribe button, click that bell. That way you get notified every time I launch a new video. That way you are notified the next 2 videos that I launch about the other 2 lies. I'm gonna get into great detail about if you about these three lies, including this one, the other two, and what you can do about it and what you can do to understand it. And with this one, remember, it's not about getting that short-term tax deferral. You have to have a long-term view. You cannot think about how do I reduce my tax liability today, because in doing that, there's always an opportunity cost. And the opportunity cost is you're giving up control of that money and you're putting it in the control of a government that has been irresponsible, that is in higher debt than ever, almost $30 trillion in debt, has almost $200 trillion of unfunded liabilities. And ultimately, guys, I mean, look at it this way. We are at all-time low interest rates. Like I said, interest rates have nowhere to go but up. And when they do, the tax revenue is going to have to go up. So everything is leaning on the fact that taxes are going up. So if I'm you, I'm looking at that, just the historical document, the historical proof that I just showed you that taxes have to go up. So put yourself in the path of success. Don't give over control of your money and don't put it in a vehicle that you lose control of. It can't touch it without penalty until you're 59 and a half, because when the government needs to raise taxes, you're stuck. And if they decided they want to take that money from you, it is their right to do so. So that's it. Hope you found value in this. Hope you have a blessed, inspirational day, and we'll talk soon. See ya.